Good morning. My name is Emma Fontaine and I am the Governor of the Reserve Bank. My fellow Waikato Diocesan economists are Emma Harris, Nikita Lyons, Charlotte McCall and Amy Spittle, who is unable to be here today. On June the 8th, we decided to keep the official cash rate unchanged at 2.25%. We made this decision based on the following considerations: current employment conditions and net migration, domestic economic outlook, factors impacting aggregate supply, commodity prices, and the economic climates of New Zealand's major trading partners.
Inflation currently sits at 0.4%, but given the current outlook, we forecast this to rise. The unemployment rate recently increased, but is forecast to drop to 4.6% by 2020, whilst the average wage is expected to increase over the same time period. Over the past 12 months, household discretionary income has increased by around 30% according to ANZ, thus contributing to consumption spending and increasing AD. Net migration is forecast to remain high, thus contributing to increased consumption spending. As skilled migrants enter the country and obtain jobs, the employed population increases, as seen on the graph, which promotes the closing of the output gap. The New Zealand housing market remains a major source of inflationary pressure, with rising prices now spreading across the country. The national median house price for April fell by 1% from March, but was 7.7% higher than during the same time the previous year, whilst seasonally adjusted sales volumes were also up 12.8%. Increasing house prices are boosting demand through the wealth effect, as consumers spend more as a result of the increased value of their assets, thus boosting demand pull inflation. Lowering the OCR further facilitates borrowing through low interest rates. Private borrowing is nearing $500 billion, with housing debt comprising $27.5 billion. This has the potential to cause repayment issues in the future. We believe that the use of macroprudential tools, such as loan-to-value ratio restrictions, will assist in slowing the increase in house prices. Construction spending is high, with an increase in house supply in the latter stages of the Canterbury rebuild in progress. The infrastructure projects unveiled in the budget will maintain the buoyant construction sector in the future.
A third low payout season beckons for dairy farmers across the country, dampening inflationary prospects and resulting in confidence and investment levels in the industry remaining low. Prices at the global dairy trade auction have risen by 11% since March, although this comes too little too late for farmers continuing to slide into debt and experiencing negative cash flow. Fonterra contributes 7% to the country's GDP and represents more than 20% of global merchandise exports. So fallout in the industry has a significant impact on the economy. Booming investment in other sectors somewhat counteracts the languishing dairy trade. The ANZ Roy Morgan Consumer Confidence Index fell slightly to 116.2 in March quarter. The general consensus is positive among the majority as spending habits remain healthy. Business confidence remains steady and optimism is increasing. The agricultural sector is the least upbeat, whereas the construction sector is buoyant. Relatively high confidence encourages consumer spending and investment, incentivised by low interest rates creating demand pull inflation. Global commodity prices are beginning to rise from their lows of around 73 on the Bloomberg Commodity Index in January to around 87 at the beginning of June. We forecast commodity prices will continue to rise at a slow but steady rate, lifting a further 10 points on the Bloomberg Commodity Index by the middle of 2017. Oil prices are also currently subdued after hitting a 15-year low of around $30 per barrel for WTI crude oil in January of 2016. These low oil prices are keeping firms' costs of production low contributing to our current below target inflation. Prices have since begun rising steadily to about $49 per barrel for WTI crude oil in June. We predict that this trend will continue, with the oil prices pushing $60 per barrel through the start of 2017. The rising oil and commodity prices are helping to stimulate inflation by pushing up firms' costs of production, thereby reducing aggregate supply and causing cost-push inflation. However, as commodity prices are still lower than they have been for over 10 years, we consider this a weak pressure which needs continued monitoring to ensure prices contribute to the rise of inflation into the target 2% range in late 2017.
The exchange rate is currently relatively high, sitting at 74.02 on the trade-weighted index as of Tuesday the 7th of June. This is higher than was initially forecasted, supported by downward pressure on the US dollar. The high dollar has ensured little imported inflation, keeping the costs of imported raw materials down and therefore helping to increase aggregate supply. A high New Zealand dollar also means that our exports are less price competitive overseas, and that firms who export in overseas currencies, such as the US dollar, are receiving less returns for their profits. The Federal Reserve is expected to increase interest rates in late 2016 or 2017, which will cause the US dollar to depreciate and put downward pressure on other currencies, depreciating the New Zealand dollar. This will help to reverse the current deflationary pressures. It is vital that we look at the economies of other countries when considering our own, due to the nature of New Zealand as a trading nation. Commodity prices are negatively affecting many economies, with most countries experiencing relaxed monetary policy. Global growth rates are relatively modest, as shown in the graph. Australia's economy has been suffering in the face of low commodity prices. However, construction rates and low unemployment, paired with lowered interest rates, has kept growth at a moderate level. In early 2016, China's growth rate was reported to be at 6.7%, the lowest it has been since 2009. The Chinese economy is facing high levels of debt and outflow of capital, as well as a complete slowdown of activity in the manufacturing sector. Despite this, the services sector is growing, and consumer confidence in China remains upbeat, sitting at 145.0 on the ANZ Roy Morgan Consumer Confidence Index in April. The US economy has been a cause for concern, with weak inflation thus postponing the anticipated increases by the Federal Reserve. However, the US unemployment rate has fallen to 5.5%, the lowest it has been since before the global financial crisis. Inflation rates in our major trading partners are currently low. However, these are expected to increase in the coming year. The potential for the United Kingdom to exit the European Union contributes to uncertainty within the economy, as the move may harm New Zealand's exporters. The EU is New Zealand's fourth largest trading partner, and the anticipated erratic effects of Brexit for the UK, fueled by economic pessimism, are expected to result in decreased New Zealand exports. There is currently spare capacity in the economy, as evidenced by the moderate output gap. However, increased migration will further increase domestic demands and employment, moving New Zealand closer to full capacity.
In summary, aggregate supply is impacted by the following factors. Although there are dairy sector challenges impacting aggregate demand, the inflationary factors listed outweigh this, promoting demand pull inflation. Overall deflationary factors are easing, and we think that the extent to which they influence CPI inflation is limited. We believe that a change in the OCR would not be appropriate due to the current state of the economy. It would generate unnecessary instability, particularly in the housing and dairy sectors, and we see that modest growth will be achieved given the current and projected momentum of the economy. It is expected that the effects of past OCR decreases, the first of which was in June of last year, will continue to be felt as the period of lag expires, creating capacity pressures as the output gap closes. This will allow the New Zealand economy to settle near the 2% inflation midpoint target range of the Policy Targets Agreement. The key risks to our forecast are global instability if the United Kingdom votes to leave the EU, house price inflation not slowing as expected, and the New Zealand dollar not depreciating as predicted. We will continue to monitor the climate of the New Zealand economy in order to determine whether further changes will be necessary in the future.
Yeah, thanks very much, team. That was really comprehensive. Well, what I'd like to do now is just ask a question that perhaps you've already covered in your presentation, but it's going to be a way of just testing how good your understanding really is. So you've recommended to hold the OCR that turned out to be a good forecast, because that's what we did. But I want you to imagine that if instead the OCR was lowered, how might that impact the New Zealand economy?
Well, firstly, we could expect that it would depreciate the New Zealand dollar, right?
Yeah, so I would say that, well, it would do that because loans would, interest rates, would immediately decrease, which would make New Zealand less attractive to overseas investors, which would decrease the demand for the New Zealand dollar, and they would be more likely to take it elsewhere, so that would increase supply, which would cause the New Zealand dollar to depreciate, which would in turn impact aggregate demand by increasing net exports, because
increasing exports.
increasing net exports because less price competitive,
Increased demand
or
and
more
decrease
price
increasing
competitive
aggregate
exports.
Yeah, so that's
Because it makes our exports more price competitive overseas,
Yeah,
and hence we get more return for
and
them.
also decrease aggregate supply because imports less
imported more raw materials
are more expensive.
relatively more expensive.
Yeah, and then there's also that'll increase consumer spending because there's less incentive to save, and it'll increase investment because there's less, and also it'll lower interest rates for mortgages and stuff, so people will have more disposable income, which all increases consumption spending, which increases aggregate demand and is therefore inflationary.
And it could also drive house prices up further as more people are taking out loans, as it's relatively less expensive.
Yeah, and the borrowing in New Zealand is currently a big problem. So that
there's a lot of debt.
Yeah, so the main things are how it increases AD by increasing investment, consumption, and net exports, and increases
disposable
aggregate supply by
ultimately,
the import,
especially for the
raw materials.
housing thing, making borrowing cheaper by lowering the OCR would be a risk because it'll be unstable, and if the housing prices were to fall, it would be negative for the economy.
Okay. Yeah. So we see that if we were to decrease the OCR, firstly, it would be less attractive for investors to invest in the New Zealand economy. So we'll see a decrease in the demand for the New Zealand dollar, and also an increase in supply, and therefore a depreciation of the New Zealand dollar. We will also see increase in exports to New Zealand as they are relatively more affordable, and a decrease in imports, and thus we see that this creates demand pull inflation. We also see that it will promote saving and investing and increase the disposable income of households, which also puts upwards pressure on aggregate demand and is therefore inflationary. And we also see that because imported raw materials will become relatively more affordable, relatively less affordable, we will see a decrease in aggregate supply, which results in cost push inflation. We also see that it has the potential to push up house prices as more loans will be taken out, and borrowing risks increase, which will generate instability, as we mentioned in our presentation.
Okay, great, thanks team. So annual net immigration to New Zealand is currently at a record high. What impact would you expect this to have on the New Zealand economy?
Increased consumption because of having more people to consume. So
we've also seen how increasing the amount of people coming to New Zealand and obtaining jobs hasn't actually increased the employment rate, and
The unemployment rate?
It hasn't decreased the unemployment rate, but the employment rate's increased.
It hasn't had an effect on the unemployment.
Increases growth. You could also say because they're skilled workers, it can increase productivity.
Mm.
It can also, or it has increased demand for housing, which has contributed to the housing, high housing prices.
Yeah, and the housing problem.
Yeah, so it'll increase AD mostly, but yeah.
Yeah, and again with the unemployment, it's currently higher than the NAIRU, which is 5.4, and we've got 5.7, and
So
that's a
that's a
deflationary pressure, because of the
Yeah, and it makes it.
As the output gap is being kept wide. By
Yeah.
the
Which is
employment.
deflationary.
because unemployment relative to population relative to population isn't changing.
So it was keeping the output gap.
Wide.
Yeah,
It
moderate,
hasn't
not-
been
okay.
closing.
Yeah.
Even though a greater number of people are
Mm.
employed.
Yeah.
Because it's relative to population.
Yeah.
Yeah, so like the overall. I was trying to think the overall impact on inflation.
On the New Zealand economy.
Yeah, because we'll have growth in the economy from like more people coming in, so and AD increasing.
Because there's more consumption, so there's AD increasing. But then there's
Yeah, but it's also,
NAIRU deflationary pressure.
yeah,
I think
It would be because you would be on the AD curve would be down the flatter part. I mean the AS curve, sorry,
Yeah.
would be on the flatter part, so it would be less inflationary than if it was further up.
because we've got
Right,
spare
yeah.
Okay, yeah.
resources.
so it's still
because we
inflationary,
necessitate
but
the
it's
economy.
It's just a small
I think we should leave it
at the moment.
at the moment because of the output gap.
Okay. So we see that the increased net migration into New Zealand, firstly, we see an increase in consumption spending as there are more people entering the country, which causes demand pull inflation. However, we see that there has been no decrease in the unemployment rate because of this, but employment has increased. This is relative to the population, and we also see that we're getting in more skilled workers, which helps increase the productivity of firms. We also see that this increased immigration is putting pressures on the housing crisis by increasing housing demand and contributing to this housing problem. Ultimately, we also see that it's a relatively small inflationary pressure at the moment because currently the unemployment rate is higher than the NAIRU, which is a deflationary pressure, which essentially inhibits the closing of the output gap relative to the population because of the influx of these migrants. But we also see that it helps to increase aggregate demand because of the increased spending.
Great, thank you, team. Very comprehensive answer. What do you think the Reserve Bank will need to do over the next few years to the OCR in order to meet its objectives under the PTA?
Possibly need to continue dropping due to the high New Zealand dollar,
yeah.
and
Possibly by like 50 more basis points?
yeah,
Or 0.5, sorry.
Well, yeah, over the next, it depends. I guess it depends, especially on the impact, the global,
Because
because at the moment there's a lot of uncertainty in the global economy around the US presidential elections and the Brexit. So that'll have to be monitored pretty closely.
The New Zealand dollar is currently overvalued, being like 6% higher than what the Reserve Bank assumed it to be. So it's possible that you could see a natural correction of that, but that will all depend, as Charlotte said, on the global
economy.
Yeah,
and
also
instability.
because of the instability, a lot of other global banks have very low interest rates, so we're relatively high. So there needs to be more convergence in order to get the New Zealand dollar lower.
So we
Yeah.
do need
So
to.
we kind of need to
I just
follow
have to be
trend.
careful not to do it so much that we end up with having problems with private debt, which is now
Which is also
like
an issue.
163% or whatever.
And the recent big problem, lowering the OCR, lowering interest rates is contributes to the housing crisis. But the macroprudential policies that the Reserve Bank is implementing in September would give them leeway to do that without having such a detrimental effect
Yeah.
on housing,
Yeah.
because you need require the 40% deposit for investors and 20% for
So-
home buyers. Yeah.
What
So
like main points would we like to?
that it'll have to be decreased.
Yeah.
And then macroprudential for the housing.
What I think the question was.
Yeah,
As
continued
possible.
implementation.
And just close monitoring of global the
Because
climate
global
and what
economy.
happened, the impacts of like things like the Brexit and stuff like that, and
Okay.
Because the New
whether the Chinese economy is able to recover.
yeah.
So we see in the future the OCR should be decreased over the next year or so, and this is because of the current high New Zealand dollar, which, as we discussed, is overvalued. And so we're hoping for a natural correction of this, but this depends all on the state of the global economy, where there's currently widespread uncertainty. So this will have to be monitored, and these are factors such as Brexit and the US election and the economic situation in China. We also see that comparative to banks around the world, New Zealand's interest rates are relatively high, so decreasing the OCR would help to address this. And we see that lowering interest rates may put pressure on the housing market, but we see that the macroprudential tools that the Reserve Bank has recently implemented essentially gives more leeway to be able to decrease the OCR without heightening this risk.
Okay, great. Thanks, Tim. So, as you noted, the Reserve Bank recently proposed to tighten LVR restrictions in response to rising financial stability risks associated with the housing market. Can you identify some strengths and weaknesses of LVR restrictions?
It has been the ones that were introduced earlier were successful in the short term
Yeah.
to decrease borrowing.
So I think, in the long term, perhaps they're not a viable option.
They're not like would you say they're not like a, one of
They're
their
not,
prudent?
Is it the strength how we were, because if we have too much investment in the housing sector, it's considered a passive investment, which doesn't contribute to GDP growth in the economy. So by discouraging investors, by placing the LVR, we can discourage investors because they need the 40%.
So that's a strength.
So a strength would be that it would help to encourage, I can't remember the word, there's passive investment and then active maybe?
Yeah,
active
which
investment.
contributes to growth in
Yeah,
real
encourage
GDP,
investment
whereas housing
elsewhere.
doesn't.
Yeah,
Although
so that would be a strength.
Weaknesses of the LVR.
in the short term, before the house prices have fully lowered, it can price families out of the housing market as they don't have the deposit.
Yeah, so it makes, although it's good because we don't want
It's good once the problem has been solved,
Yeah.
but in the short term,
lowering
it can
housing demand for
continue
households, individual households is
Yeah.
negative thing.
especially for lower income houses.
Lowering what demand, sorry?
Although they also wouldn't be able to afford a house if the house prices continued rising.
Yeah.
So just
Yeah, and
being
also
priced
a
out
strength
in the
is
short term.
a strength is it decreases demand, like kind of contributes to stability in the market, because with the instability there's always the risk, even though house prices are really high, of the housing bubble popping and houses dropping radically in price, and then of course mortgages are greater than the value of the house and people default on mortgages, which creates problems for banks, and so it reduces the risk of that, which is positive.
So it's reducing the risk of a really sharp drop and a
Yeah.
pop. Okay.
It's reducing
Do we have more weaknesses?
weaknesses.
We've just got people being priced out of buying homes.
With houses overvalued currently, it would still because it's by the ratio, the 40% of the you need 40% of the value of the house. Therefore, it would still be. It's not relative to income
Oh yeah.
as well. So if you had that money but you still had a low income, you might not be able to.
Because of the
Pay it.
overvaluing.
Yeah.
So it's kind of subjective.
When
What were you saying
kind of-
before about demand and the weaknesses?
demand.
Something about individual household demand.
Not sure.
No,
It could
I'm
push,
not sure, just
could push up the price
got
of rents and stuff like that because people can't afford to buy.
Yeah, that's
So it's gonna
that would be happening anyway.
It's in the short term the effect on the individual buyer who can't afford a house, and the problems with seeing people. I guess it's not. It's more a social kind of issue, not explicitly financial, but it's still a weakness of the LVR.
So it's just people not being able to afford a house.
We should summarise. If there's anything more? No,
I think that's about it.
So in terms of loan to value ratios, we see that the strengths of this macroprudential policy is that it has had proven success, short-term success in the past. We also see that it helps to promote more active investment, because investing in households is a passive investment, and this benefits and helps to promote growth in the economy by discouraging investment in the passive household market towards more active things to boost growth. We also see that it promotes stability in the housing market, so rather than seeing a sharp drop in housing prices in the future and seeing a pop of the housing bubble, we see that the loan to value ratios create a sense of stability here, and this can essentially be somewhat avoided. However, for weaknesses, we see that in the short term, loan to value ratios price out homeowners from their homes, and it has some social flow-ons wherein they can't afford to buy a house or pay for their rent, and as we discussed, houses are currently quite overvalued, so relative to income it may be difficult for some people to actually cover this ratio.
Great, thank you guys. We have time just for one more quick question. So the latest outturn for CPI was 0.4% on an annual basis. Do you think the Reserve Bank is meeting its target, its goals under the PTA?
Because the PTA is for the medium term, as where it's the Reserve Bank is working to get it towards the 1 to 3% range. It kind of is.
Because there's a period of lag after you
Yeah.
decrease the OCR, so...
Yeah, but they should be thinking 2 years in ahead.
Yeah.
So they should be thinking like 18 months in ahead when they make decisions.
But I think I suppose it more depends on it. Yes, it was 0.4 in that quarter, but is it rising or is it continuing to fall? And so because it's working to maintain price stability in that range.
Yeah, it's not so negative. Like the 0.4 in itself is not extremely negative. If it's on a
If
huge
it's rising.
decrease or on a huge increase,
Yeah.
stability is
We just
important.
don't want it to fall to
Yeah.
deflation, to zero,
And also
because that's when we have
depending-
problems. Sorry.
Continue.
Oh, I was just going to say that's when we have problems.
Depending on also whether the figures are seasonally adjusted,
Yeah.
as there is the variation due to different seasons, different spending habits and pricing of goods and services.
Yeah, I think that the Reserve Bank, given the housing crisis
Global conditions.
and stability, global conditions, lowering the OCR, which would theoretically increase inflation, hasn't been as much of a it's not feasible. So I think that it hasn't been feasible in the past. So I think that given those conditions, the Reserve Bank has
By decreasing it in slow intervals,
Yeah, and I think that the tools, the macroprudential tools we've already talked about, things like that give the bank leeway to lower the OCR further, which is what would promote inflation. So I think...
But overall, whether it's actually meeting the goal, you could say that because we're not in that target range currently, that they're not meeting the goal, but in reality, the fact that a lot of predictions, such as it was predicted that New Zealand dollar would be have fallen a bit by now, and it hasn't. Those sorts of economic conditions that haven't reacted as predicted, they would be means that inflation hasn't reacted as it was initially predicted. So as long as the Reserve Bank is adapting to these situations, which it does, then they're still working towards that goal, which can't be seen as not meeting it.
Yeah. So in terms of the Reserve Bank meeting the goals of the policy targets agreement. Firstly, we see that the policy target agreement is applying in the medium term, and we see that with the current inflation rate at 0.4%, determining whether or not they're meeting the policy targets agreement essentially depends on whether the inflation rate is predicted to rise or fall, and in this case it's expected to rise. And we also see that the Reserve Bank is working towards promoting price stability as well, and we see that there are many things that the Reserve Bank needs to take into account when attempting to meet the policy targets agreement, such as whether the figures are seasonally adjusted in terms of spending habits, the housing crisis and global conditions, and as well as the 9 to 12 month lag of the changes in the OCR. We see that the macroprudential tools that are currently being implemented are giving the Reserve Bank a bit of leeway with the OCR, so that they're able to try and meet this agreement. We see that currently because inflation is not within the target range of 1 to 3%, they're not meeting the policy targets agreement, but considering other factors such as predictions which have not been actually met because of other factors in the economy, we see that the Reserve Bank is doing the best that they can to adapt to changes in the economy and the current global instability and the things like the high New Zealand dollar. And so we see that in the long term, the Reserve Bank is meeting the goals of the policy targets agreement.
Excellent, thank you.
Fantastic. I was worried you'd say that we weren't, but okay. Hey, thanks very much, girls. There were some really great answers there. Particularly that last question that Dan asked is pretty difficult. So well done.